Welcome back. We've got some breaking economic data coming out of Singapore here for the month of August. This is non-oil domestic exports, up by 6.7% month on month sequentially. So that has outperformed the Reuters poll of expectations, calling for a 2.5% increase. Non-oil domestic exports on a year-on-year basis contracted by almost 9%. So that's bad, but not as bad as what the Reuters poll of expectations was calling for, which was a 12.2% dip. Nonetheless, when you look at the historic context here, exports are down for the 6th month. Let's break it down a little bit further for you. Domestic exports of electronics, very hefty fall in the month of August, down by almost 26% year on year. NODOX to the US, down by 15% year on year. But here's a surprise, Nancy and Steve. August NODOX to China jumping almost 39% on a year-on-year basis, but the number to Europe looking pretty soggy, I must say, down by 11% on a year-on-year basis. Right, let's bring in Aaron Pataki now, Portfolio Manager from BNY Mellon Investment Management, who joins us live from Sydney. Still with us is our guest host, Stephen Davis. Aaron, what did you make of these numbers? And from a portfolio allocation point of view, does it just underline the need to de-risk and continue de-risking portfolios and play defence?
Yes, so basically improved economic data surprises and also encouraging trade news flow do not change my cautious view. Economic surprise indices point to a less negative growth outlook compared to the beginning of August. But this is just a reflection of more bearish analyst estimates and also mildly improving economic data. So we maintain our cautious outlook and certainly have been focusing on de-risking our portfolios. We have exposure to long duration assets and also a combination of gold and indirect currency positions that we use as a hedge against our risk assets.
Aaron, yet when you talk about the shift in growth expectations, I mean, not being quite as bad as what we saw at the start of August, we've seen some of that reflected in the bond markets. Treasury yields, most prominently in the U.S., have been rising, but elsewhere as well. This makes me wonder, do you think we did in fact test the lows already, or could we see bond yields go lower once again, perhaps even lower than what we saw at the start of August?
Well, certainly the fall in bond yields has been very sharp and rapid. So in the short term, I think we could see a backup in yields. But I think overall, the deflationary pressures in the economy are going to trump short-term inflationary trends. So I strongly believe that bond yields have further scope to fall. And it will be quite interesting to see what the Fed's reaction will be to the recent geopolitical events and obviously slowing growth in the US, whether the expected policy response will come through tomorrow or not.
So, Aaron, what is your expectation from tomorrow? Are we going to see the 25 basis points that everybody's been pricing in, or are we going to see something that's a little bit more or even less aggressive?
Yeah, so as widely expected, I look for a 25 basis point cut in the Fed funds rate by the FOMC. I think the case for a rate cut has increased quite significantly since the last FOMC meeting in July. Data flow has been softer and uncertainty remains in the outlook. I also think that the policy statement will indicate possibility of further cuts dependent on the state of the economy. I think a more than 25 basis point cut would potentially send the wrong message to the market. A 50 basis point cut could signal that the Fed is overly concerned about the state of the US economy and could trigger a sell-off in risk assets and potentially lead to tightening of financial conditions. It will be interesting to see whether Powell will explicitly refer to recent policy action as a mid-cycle adjustment, recalibration of policy. I think that's actually not the case. I expect this to be expect the start of a more sustained easing cycle. It will be quite interesting to see. Yeah.
I was just going to say, what do you think would justify that change in tone from the Fed, though, given that many data points continue to hold up and we are starting to see signs of inflation?
Yes, well, the real economy has softened, so I think there is justification for a rate cut, and you could argue that potentially even further cuts are needed to underpin the economy, but that's certainly not reflected in financial market prices. If you look at the equity markets, the US equity market in particular, it's trading very close to its all-time high. That's because risk assets are looking through this economic weakness and are drawing parallels between 2016 and 2019. But I think that comparison is perhaps not appropriate, because the stimulus programs that we've seen in 2016 are much more substantial than perhaps the easing measures that we're seeing from the ECB, from the Federal Reserve, and also from other central banks. So I think that the cut in interest rates in the US is justified and are needed to underpin the economy.
Aaron, how concerned are you about the persistent strength in the US dollar and the likelihood that that could take something of a wrecking ball to US earnings? Is that going to be a risk-off catalyst as we move towards the final quarter of the year, or is that pretty much baked into the price?
Yes, I think the strong dollar is going to have an impact on earnings, and I think it will be interesting to see what the market reaction will be to potentially a 25 basis point rate cut. My base case is that that's going to cause a front-end rally, a steepening of the yield curve, and potentially lead to a mildly softer dollar, which could help earnings in the coming quarters. But ultimately, I think the US dollar is going to act as a safe haven currency. So if volatility will pick up again in capital markets, then I expect the US dollar to remain strong. And of course, that could undermine earnings of international companies.
Aaron, thank you so much for joining us. We do appreciate your time. That is Aaron Pataki there from BNY Mellon Investment Management. And Stephen Davis stays with us. Lots more coming up for you on Squawk, including Washington's response to the aftermath of the Aramco attack. We will be right back.
Markets, the business of trading goods and services. NASDAQ operates among the largest markets in the world, and our technology powers markets from Indonesia to Chile. Great markets are built on a foundation of trust and integrity, forged through leading-edge technology and a smart regulatory framework. As technology advances, regulation must keep pace to allow the markets to evolve. Today, we see an opportunity to modernize regulation, to make markets more accessible to investors and entrepreneurs of all sizes. From the graduate buying her first stock to an institution investing in thousands, the markets belong to everyone and stand as a symbol of economic advancement, social progress, and limitless opportunity. That's the tomorrow that we envision. And to get there, we'll have to rewrite it today.
A little bit of California in every grape.
I'd like to donate these books.
Thank you very much.
Where'd you get that book?
A man donated it.
Yes?
I'm sorry, but I need to retrieve
I don't leave you looking for this.
No. Thank you so much.
Be return the book.
Right, let's take a look at the price of oil Asia side. We are seeing a degree of stabilisation, but I hasten to add that it looks as though the risk premium is here to stay and sticky. The attack on Saudi Aramco disrupted about half of its daily output, and there has been no update yet from the company officially on how much capacity has been restored. Matt Taylor has more. So the return of the barrels to the physical market, that's what the market needs to know. Are we getting any visibility?